don't have to make $1 million to start this process. This is the point. 3, how to grow it. So there's turnaround deals, homers. That's what I call them, turnaround deals. There's homers. Homers are like, we're gonna show that in a second. But you don't need to always do this. You don't need, every deal does not need to be a home run. And then, so I think there's the turnaround deals, right? There's the buy, renovate, refi, tax-free. Get all your money back, or ideally a lot of your money back, home run. You can get all your money back, home run. How do you calculate that? Well, I'll show it in a second just through my own example. And then the cash flow deals. These type of deals, right? And we're gonna go through that example. I would call these single, doubles, and triples. But I used to think I would never wanna hit a single. I was like, I want this. Now I'm like, if I could just stop waiting around for years on end for these, it might take me 3 years to do one of these, or I might think it's one of these, but then get burned, when in reality, I should just be every year contributing to this single bucket. So this has also been my mistake. But the money just sitting there for 3 years on end, not doing anything, sitting at UBS even for 2%, but that 2% dividend, if you have 2% on the stock, it's getting chopped in half by the government. It's really 1. When you always think get money to work, people are always saying that. It's because they understand the nature of compound interest, and waiting around for these homers that might be a little bit riskier also, or might never come, while you could have been investing in singles and doubles along the way, this actually might get you, the tortoise wins the race. So why real estate as opposed to stocks or anything else, right? Depreciation, this is just huge. You can't get this anywhere else. It doesn't exist anywhere else that I know of other than investing in solar cell tech things, just some very weird things in the tax code, but real estate's the only one. And residential is 27 and a half years. Commercial property, single tenant, 39 years, right there? 39. Yeah, there's some.
Gas stations, 15.
Yeah, gas stations are 15. I'm not going to talk about it on this video, but there's some bonus depreciation assets that could be triple net lease that you guys all know what I'm talking about. That, how do you calculate the return on that? So why real estate? Depreciation, debt pay down, that's happening secretly in the background. Cash flow after the debt pay down and debt service, right? The appreciation from increased NOI. So look, this is fucking simple. Increase the NOI, property goes up, generally speaking. I don't need to understand a whole prospectus of a gigantic corporate company. I need to know if I can take a building and improve the NOI over time. Because this is an easy game. Bank give you more money when NOI is up. Investor give you more money when NOI is up. Especially in New York City in a supply constrained area, where it's gonna happen probably naturally just because of that reason. And there's always a buyer in New York City. Look what happened this year, right? If you're buying on NOI, right, the homer deals were the ones that people got caught, like I'm talking about, right? The people that are in trouble right now are the ones that were trying to play that game and buying the 3 caps and whatever else. But if they had just hit a single, they're not in trouble right now. Their mortgages are extended out, they're not at any risk. The simplicity of the game here is what I want to underscore. Right? It's very simple. And then it's an inflation hedge. Real estate's an inflation hedge. So as the cost of goods go up, the cost of contractors goes up, the cost of replacing the bricks goes up. These buildings have value that will be tied to inflation. Real estate is a great inflation hedge. And even more so in New York City. Why is New York City so expensive? Supply constrained, but it's also because it's so difficult to get goods and services in here. Just to cross that bridge, you can't haul a 20-wheeler truck into Midtown Manhattan the way that you could out in Connecticut. So that whole thing of that process of all the goods and services, all the people have to come in and out every day. You can only work between 9 and 4 or whatever it is. This all adds to the cost of the buildings, which is just going up. So again, going to the whole Warren Buffett, don't lose principal. Investing in New York City, if you buy at the right cap rate day one, pretty safe bet. I'll run through this real quick, just a part of my early beginning story, just to show you what a homer looks like and how you can, if you know the rules of the game, you can own a building for free. And once you own a building for free, once you have no money in the deal anymore, and it's still producing you cash flow, it's still sheltering your earned income, it's still giving you that depreciation, and it still has upside that if another tenant leaves or the rents go up, you could tap into that refi again or sell it. It's hard to compute the returns. I'm not a math enough genius to compute them. It's big. You got all your money back and then it's just infinite. I'm gonna own this building to the day I die probably. It's gonna be like a piggy bank forever. First deal, 6 units, Dan, this is the funny training exercise. I'll tell you guys the story later. I literally was like typing to the client, like, it is worth more money and I'm a broker. I want to sell for you. He's like, I will not pay a commission. I will not pay a commission. Like, I was so documented because I was so scared. But anyway, bought the 6-family for $625, got a 75% mortgage on it. So we put $468 down, which means how much money do we have to put up? $156, right? I had a partner, $80,000 each. Again, less than 100. But you got to have the 80 on hand. $80,000 in equity. Here's the rent roll when we bought it. 3 vacant apartments, then 3 rent stabilized, $900,000, $1,000. After we renovated, these are what the rents became: $1,000, $3,200 for the duplex, $2,500, $2,700, $1,000, $900. I just kept, for simplicity's sake, these exact rents, although the rent stabilized have gone up a little bit. So the building, I spent $350,000 in the renovation out of pocket. I could have taken a little hard money loan. I wouldn't advise that, but there is a way to do that as well. So our all-in, right, we had $156,000 in equity, and this all happened within a year's time, plus $300. But that year, it doesn't even matter to me that the building lost money. It just came off my, my earned income. It really wasn't a loss at all. It's like it was either going to uncle or it was going to this building that I bought. $156,000 equity plus $350,000 improvements means I had $506,000 in cash in the deal. So when you're buying something, you got to know where the high watermarks are, and you need to know what your takeout is. Your takeout's either a sale, but I wouldn't recommend that. Even though we're brokers, the takeout is really what the bank is going to give me after I convert and improve this NOI. Again, it's not a complicated formula. It's just doing the numbers based upon the improved NOI. Using these new rents, 11.3 per month times 12, $135,600. Every 6-family basically has $35,000 of expenses. So our new NOI was $100,600. If you do the debt coverage ratio again, and if you guys don't understand how to do this, I'll show it to you, but you need to understand what the bank will give you as a total loan amount in total value, how many dollars based upon that NOI. And it's a function of what interest rates are and what the debt coverage ratio is. 1.35 debt coverage ratio just means that the NOI needs to cover 135% of what they will give you as a loan amount. You can reverse engineer this in a financial calculator in 2 seconds. I'm sure most of you know how to do it, but you should be studying this all the time. How much NOI do I need to increase in order to get all my principal back? 1.35 debt coverage at 4%, 30-year amortization means technically if they were following this procedure, I should have been able to get $1.35 million. For whatever reason, it was $1.2 million that they offered on the loan option. We took that. Took a $1.2 million mortgage, and this is probably 12 months after we bought the building. I was into it for $506, remember? Our original loan was $468, 75%. Our refi proceeds was $732. So $1.2 million check that the bank gave me minus paying off the previous bank of $468 means a check at closing was given to us of $732,000, $415,000 per person, or whatever that number is. A little bit less than that, okay? This number is bigger than this number, is it not?
But you still have to pay off your improvements that you made.
No. $156,000 to close. I came up with this out of cash. So I'm into the deal for $506,000 in equity, in cash. New loan of 1.2 minus the old loan of 468 means at the closing check, the bank said, hey, we're happy to pay you this new loan amount. You've improved the value of the building. It can cover, our debt times, with a buffer of 35%. Okay, they're happy to do it. This is how banks make money. Yeah, refinance is you're partnering with the bank. The bank is a much cheaper partner than private equity. Private equity is going to want 6-7%. The bank is charging 4%, right? They're the cheapest option. They're always the best option. So $732,000. So I got all my cash back plus a profit for my time. And this is non-taxable. So as long as you understand what you got to drive the NOI to and you reverse engineer what the bank will give you when it's over with, then you can figure out how quickly can I get my money back. If you can even get your money back and then own a depreciable asset that produces cash flow for the rest of your life, like how do you compute that return? Seriously. And then, okay, over time, one of these units go out, one of these units go out. Okay, spend a little bit more money, tap it in the bank again. Pull out another cash out refi. I will own this building most likely till the day I die. And if I ever do sell it, I'll exchange it and just buy something bigger, right?
What's the magic number that you'd sell at today?
There's no point in selling.
I'm just used to saying that though. Right?
No, I know, but there's no point in selling when a deal has, when it's not maintenance, it's producing cash flow. But this is serious stuff. Like you should be looking for these type of things.
Until you run out of depreciation, right?
Yeah, until you're right. Yeah, 30 years from now, maybe I'll do a cost seg if I really want to, take out more of my earned income. But yeah, 30 years from now, that benefit might not be there. But 30 years from now, the reason why those guys don't do it, they don't care anymore. It's just like they're so set, it doesn't matter. 732,000 divided by 506 means I made 145% of my money just on the refinance, tax-free, right? Crazy. We didn't have to wait 10 years to do that. We did it in a year. Okay, this is more than a double. Okay. And it still cash flows $36,000 a year. The new mortgage amount, $1.2 million at 4%, 30-year amortization. The debt service is $69,000. My NOI was $105 minus $69 in debt service is $36,000 in cash flow, which is shielded by $28,000 in depreciation. I'm actually keeping this money. If you close a deal for 36 grand, government taking it. I own a building for free. I got paid another 100 grand on top of all the original money I put into it or whatever else. And this sucker, at worst, is going to produce $18,000 a year back to me every single month, $1,500 a month. I get a check. My depreciation is based on my new basis. So $625 plus $350, and then 80% to that.
So you depreciate your improvements?
Yeah, that adds to your basis. So the government, the basis, I forget the exact calculations, it's 20% of the, it's usually like, you can't depreciate land, right? So when you buy a building for $1 million, there's a part that's allocated to land and a part that's allocated to a building. So you can only depreciate the building part. So I just did 80% of 625 plus a full 350. That divided by 27.5-year schedule is $28,000 in depreciation. That opening that check every single month of $1,500 and knowing that I have all this upside, a management company runs it, I don't deal with it at all, really. But that is a seductive, addictive envelope. That's what makes me realize, and that's why I'm having this conversation with you, because you start adding those things up, it just changes the whole game. But you can't do it unless you sacrifice now. So I won't go into deal number 2 exactly. Well, I'll just do it real quick, right? So I got all my money back, right? I got 732 divided by 2. What's 732,000 divided by 2? 378. Yeah. So this building paid for the entire second one to buy it, right? So building number 2, and this happened right afterwards. Building number 2 was $1,035,000. What's 70% of $1,035,000?
700 and change.
Just give me the exact amount.
724.5.
So what does that leave? What's 30% of $1,035,000?
310, 500.
What did you just say I got out of that refinance?
366 and change.
Yeah, so I still had some money left over. So that refinance paid for the buy of the second building. Second building did the same thing. Fully occupied, whatever, tenants left. They wanted to leave. They wanted to go buy a house in Middle Village. We took that building, fully gut renovated, spent way too much money, and the money was fresh capital. I had to keep earning income, right? I had to keep earning income to pay for this. I didn't have enough. But that 6 family, another 6 family, loved the building. Bought it for $1,035,000. Probably after closing costs and everything else, we were into it for 1.1, and we spent about $900,000 renovating it. And I mean, it's head to toe. Like this thing won't need every screw ripped out, sub rehab. So we're into it. Plus 900 equals 2 million all in. Our NOI there, it's basically like 3,200, and then call it 25 times 4. So it's 10, 6,400. So 16,400 a month. Give me the number. What's the yearly?
96.8.
What is it?
196,800.
196. Let's just do that. Minus 35,000 again of expenses. They're even less than that. Equals $155,000 NOI.
127,920.
Okay. Right, $155,000 NOI. Again, so does anyone know how to do this? What's the bank going to give me? Interest rates there are 3.75%. $155,000 divided by 12. That's my payment for, hold on, that's going to do 3.75. $155,000 divided by 1.3% or 1.3 debt coverage ratio. Divided by 12. My max payment's $9,900. 3.75%, 30-year amortization. Means the bank is going to give me on cash flow, up to a loan amount of $2,145,000. We took out $2 million. So again, how much?